What's up YouTube? It's me Gio from Robinhood Investing with Gio. In today's video, I wanted to discuss how to sell covered calls for beginners. There's a whole lot of new investors in the market in 2021 and some of them want to make a little bit extra income at the end of each week. In this video, I'm going to show you how. Stay tuned everyone. What's up YouTube family? Just a friendly reminder, if you enjoy content that is free and not hidden behind paywalls, and if you enjoy content that is informative and educational, consider subscribing to my channel. Alright everyone, let's get into this. What's up YouTube family, welcome back. So today's video we're going to discuss on how to trade options for stocks, ETFs, or bonds. In this example, I will grab a stock. I'll use Virgin Galactic. So in order to get started, we go to Trade Options, space. In our previous video, you recall we bought a call. In this video, we're going to sell a call. Selling calls is a great way to short a stock, but it's also an amazing way to get passive income. An important thing to understand when you're selling a call is that in order to sell a call, you must own at least 100 shares of the stock, ETF, or bond that you'll be selling. Difference between buying a call is you do not need to own 100 shares of the stock. As a buyer, you are the one that's buying the stock from the person that is selling. And in this case, we would be the seller. So the only way we can sell our stock to a buyer is by having 100 shares and converting them into a contract. In this example, we see Virgin Galactic is currently trading at $24.32. In order for us to be able to sell Virgin Galactic, we would have to have a total of 100 shares of Virgin Galactic. So that would be a total of $2,432 at our disposal. So what we can do when we have these 100 shares is we can sell contracts. In this example, we will use the strike price of $25. So what we're saying is, as a seller, we believe that Virgin Galactic will not go above $25. And if it does, we will sell you our shares. Essentially, when you sell call options, you are bearish and you are shorting a stock. In this example, the buyer would say, all right, if it does go above $25, I get to keep them. And my payment to you as a seller is I will give you 34 cents for every share that you sell me. And since we're selling one contract and one contract is 100 shares, this would be 34 cents times 100, which equates to a total of $34. Now let's say we had more than 100 shares, and instead we had 200 or maybe 300. The more shares we have in multiples of 100, the more contracts we can sell. So if we have 2 contracts, that would mean we can get a premium of $68. If we had 300 shares, we can get a premium of $102. An important thing to remember about this is that these contracts have an expiration date. In this example, this expiration date is January 8th, 2021. So what we're saying is the current price of $24.32 will not go above $25. And if it does, I am obligated to sell you my shares if you so choose to take them. So in this example, we see that the break even is $25.34. What that's accounting for is essentially for the strike price, but also it's accounting for the 34 cents. To further understand this, as I mentioned before, the share price of Virgin Galactic is currently $24.32, and our break even is $25.34. So if the price does go up there to $25 plus, we still get a massive profit overall. In this example, we would add the break even of this contract, which is $25.34, and we would deduct it by the current share price. 24.32. So it would be $1.02. But once again, we're multiplying by 100. So this would equate to $102 of profit if we were so to happen to choose to sell this stock or forced to sell the stock. To do another example, let's say the share price of Virgin Galactic goes up to $26 at expiration date, January 8th. What that would mean is that we once again get the $102. However, we missed the run-up to $26. And what that would mean overall is we would take the break-even price of $25.34 and you would take away the current price of $26, and that would equate to negative 66 cents, or once again, since it's 100 shares, negative $66. So despite the price being at $26, you would be forced to sell your shares at $25. And considering the fact that your break even is $25.34, the total upside that you missed out on was a total of $66. And your screen will display a negative number. The negative 66 would equate to the amount of money you left on the table. One important thing to know when you're selling covered calls is that you should do it on companies that you don't plan on holding or companies that you don't mind losing. If you're selling covered calls, you should not be doing it on companies that you're very fond of and you don't want to lose, because there's a potential the company could skyrocket all the way up and you would leave all kinds of money on the table and lose the stock forever. But if you do happen to have shares of companies, multiple companies that you're very fond of and don't want to get rid of, it's highly recommended that you do not select strike prices that are close to the share price. It's preferable to choose contracts that, despite paying a lot less, are a lot less risky. Our example of $25 has a 76% chance of profit. But if we go a little bit deeper, our premiums start to go lower, but our profit chance starts to increase as well. In this case, we choose a strike price of $26.50. Our profit chance goes up to 80, almost 90%, and we'd only get 12 cents of premium. But once again, let's say if we were to have 400 shares, we would sell 400 covered calls, we would get a premium of $48. And we could do this week in and week out to continue to get passive income every single week from companies that we love or companies that we don't. That'll do it for me, everyone. I hope you learned something. If you have questions, comment down below and I'd be happy to help. If you enjoyed the video, consider subscribing. Liking it, I would greatly appreciate it. My name is Gio, and I'll see you guys next time. Take care.